Anthony Scaramucci thinks the Clarity Act has better than even odds of passing by the end of July. Senator Hagerty is hoping for the same window. And the day after all that optimism, Illinois became the first state in the country to tax crypto transactions at 0.2% on every transfer, win or lose, gain or no gain. Federal clarity might be coming. State level friction just got real. This isn't financial advice, just educational content. Do your own research before making financial decisions. If this kind of breakdown is useful, hit like. It helps the channel reach more people. Let's start with the urgency argument because it's the loudest one circulating right now, and it deserves to be unpacked carefully rather than just repeated. The core warning is about timing relative to the midterms. If Republicans lose the House or lose the Senate, control of digital asset policy shifts to committee chairs who have already voted against the Clarity Act. Every finalist under consideration for the relevant House committee chairmanship voted against it when it passed the first time. That's the specific risk being raised, not a delay of a few months, but a multi-year reset where the legislative groundwork built over the past 2 years, FIT 21 2 years before this bill, then House passage a year after that, gets shelved, while a less favorable political environment controls the committees that matter. The argument for urgency is that the House already did its job, and the Senate needs to close this out before the August recess because waiting could mean waiting years, not months. There's an honest caveat embedded in that same argument, and it's worth keeping rather than smoothing over. Bitwise's Matt Hugin reportedly said the industry will be fine without the Clarity Act passing. That statement might be technically true in a narrow sense. Individual companies keep operating either way, but the deeper risk being raised is structural. Without statutory clarity, enforcement-driven regulation under a future administration becomes possible again, the same dynamic that produced years of uncertainty under prior SEC leadership. The framing here isn't that the industry collapses without this bill. It's that the protection against another adversarial regulator disappears without it. Now, here's where things get more specific because the actual procedural mechanics matter as much as the political urgency. As of May 21st, the bill needs a full vote from the Senate. That requires every Republican senator plus 7 Democrats, since Republicans hold a narrow majority short of the 60 votes needed for cloture. The realistic target being discussed is closer to 10 Democrats, as a buffer in case any Republican senators who don't believe in the asset class break from the party line. There are procedural votes happening first specifically to confirm there's enough support before committing to a full floor vote, which is its own signal. Leadership doesn't bring a bill to the floor, it expects to fail. Anthony Scaramucci, who talks regularly with senators and industry insiders, gave a specific and qualified read on where this stands. His framing is conditional rather than predictive. If the Clarity Act passes, he says he'd be far less worried about the industry's near-term path because it would mean bipartisan support got codified into law. If it doesn't pass and a strident anti-crypto SEC chair eventually replaces Paul Atkins, he expects that to create a real headwind, one he considers unfounded and unnecessary, but real nonetheless. His personal estimate is that the odds of the Clarity Act getting done before the end of July are better than 50%. That's a specific number from someone close to the process, not a guarantee. Scaramucci also made a broader argument that's worth hearing on its own terms, separate from the legislative odds. He used the Uber comparison. The taxi commission didn't want Uber. The mayor didn't want it. The medallion owners who held political power didn't want it. But the people who actually used the product wanted it, and that demand pushed through every institutional obstacle in its way. His point applied to crypto broadly is that even in a worst case political scenario, Bitcoin and the broader technology will likely overcome regulatory headwinds if the underlying product is genuinely better than what it's replacing. That's a real argument worth sitting with, though it's also the kind of analogy that proves less than it sounds like it proves. Uber operated in a market with millions of daily consumer transactions and an immediately obvious cost and convenience advantage. Whether that maps directly onto institutional financial infrastructure, where the customers are banks and asset managers rather than individual riders, is a separate question Scaramucci didn't fully address. Senator Bill Hagerty made the substantive case for the bill directly on Fox News, and his framing connects two pieces of legislation deliberately. He authored the Genius Act, which established the framework for a reserve-backed digital dollar, backed dollar for dollar by short-term U.S. Treasury securities. His argument is that the Clarity Act does for the broader digital asset market what the Genius Act already did for stablecoins specifically: provide the clear rules of the road that let innovation happen onshore rather than push it offshore. His stated timeline matches the broader consensus. This becomes the focus after the July 4th recess, with hope for completion before the end of July. But this is the part almost nobody connects to the federal timeline conversation, and it deserves direct attention. While all of this optimism about July was circulating, Illinois Governor J.B. Pritzker signed a 0.2% tax on digital asset transactions into law as part of the state's fiscal 2027 budget. This is real, specific, and already signed, not a proposal under debate. Here's what the Digital Asset Privilege Tax Act actually does. It's embedded inside a 1,624-page revenue bill that's part of Illinois' $55.9 billion fiscal year 2027 budget. The tax imposes a 0.2% charge on the value of any digital asset involved in an exchange, transfer, custody, or wallet service conducted on behalf of an Illinois customer. It takes effect January 1st, 2027. The state projects it will generate roughly $60 million annually, a small fraction of the more than $800 million in total new revenue the broader budget package is expected to produce. The detail that's drawing the sharpest criticism from industry groups is how the tax is calculated. Unlike capital gains or income tax, this levy doesn't wait for a profit. It applies to the gross value of the transaction itself, regardless of whether the customer made or lost money on the trade. A trader moving $500,000 in monthly volume through a covered platform would owe $1,000 a month in Illinois-specific tax or $12,000 a year, whether those trades were profitable or not. Out-of-state brokers become subject to the rule once their Illinois-sourced sales cross $100,000 annually, a threshold low enough to capture essentially every meaningful exchange or platform with Illinois customer exposure, including ones that have never had a physical presence in the state. The Crypto Council for Innovation called it the most punitive digital asset tax in the country in a letter to Pritzker before he signed it, and the criticism didn't soften afterward. Their core argument is comparative. No equivalent state-level tax applies to stocks, bonds, or derivatives at the transaction level the way this one applies to crypto. A 16Z's head of policy, Miles Jennings, compared the structure to taxing email, the idea being that the tax targets a category of technology rather than a category of financial risk or behavior. Chicago is home to firms like Jump Crypto and Bitnomial, and industry groups are explicit that they expect this tax to push exactly that kind of business towards states with friendlier treatment. The practical paths forward for affected platforms are narrow. Either price the 0.2% into the spread charged to Illinois customers, effectively passing the cost downstream or geo-restrict Illinois users entirely, the same technical approach major exchanges already use for jurisdictions under sanctions. Legal challenges are considered likely before the law takes effect in 2027, though nothing has been filed as of this writing that resolves the question either way. And what happens next changes everything for how you should think about the relationship between federal clarity and state level policy. Once you separate the federal timeline from what individual states are doing on their own, the picture gets a lot more interesting because the Clarity Act passing doesn't stop a state from taxing crypto transactions however it wants. Those are two completely different fights happening on two completely different boards. The Clarity Act, even in its most optimistic version, sets federal market structure rules, what counts as a security versus a commodity, who regulates what, how digital asset businesses interact with federal financial law. It does not preempt a state's ability to levy its own transaction taxes the way Illinois just did. A company could get every benefit it wanted from federal clarity and still face a state-specific tax burden that pushes its Illinois-facing operations elsewhere. Now, let me bring in the part of this conversation that's actually about what passage would mean for the asset class itself, separate from the legislative mechanics. There's a specific argument being made that Clarity Act passage benefits altcoins more than it benefits Bitcoin, and the reasoning behind it is worth examining directly rather than just accepting as a talking point. The argument is structural. Most of the regulatory clarity developments, the tokenization frameworks, the stablecoin rules, the decentralized finance guidance relate to smart contract platforms and asset classes that don't touch Bitcoin's core use case at all. Bitcoin's investment case remains centered on its role as an emerging digital store of value, which is a real and distinct thesis. But the rest of the digital asset industry, the part built around tokenization, programmable money, and decentralized applications, is the part that regulatory clarity actually unlocks in a direct, mechanical way. One industry voice framed it through the lens of index investing. If you want exposure to that broader thesis rather than just Bitcoin's specific use case, a diversified, high quality benchmark captures something Bitcoin exposure alone doesn't. The argument extends into ETF mechanics specifically, with 7-spot XRP ETFs already trading in the United States. That's a documented green light for institutional capital that didn't exist a year earlier. The observation being made is that institutional buyers have reportedly been allocating to XRP at a higher rate than to Solana, Bitcoin, or Ethereum in recent periods, while retail sentiment remains uncertain about direction. Whether that pattern holds or reverses isn't something any single data point settles, but it's a real claim worth tracking against actual fund flow data going forward, rather than treating as settled. Cody Carbone's framing of what the bill actually accomplishes is useful for cutting through some of the more speculative commentary around it. He described it plainly. This is roughly 400 pages establishing the foundational rules of the road for how crypto interacts with financial markets. What counts as which kind of token, how tokens get listed, which regulator is responsible for ensuring compliance. That's a deliberately unglamorous description, and it's also accurate. The bill's significance isn't that it guarantees any particular price outcome. It's that it removes the structural ambiguity that's kept large pools of institutional capital on the sidelines. The same capital Carbone describes as waiting specifically for this bill before competing seriously in the space. Brian Armstrong's public comments add a useful lower temperature data point to all of this. He described the Senate's posture as essentially telling both Coinbase and competing industry voices, including Brian's ongoing public exchanges with JP Morgan's Jamie Dimon, that a compromise had to happen and both sides had to accept something that wasn't their ideal version. His framing was that the bill represents a massive total addressable market expansion moment for Coinbase and crypto broadly, and his stated hope is a Senate floor vote within the next month or so, with presidential signature following within a few months after that. That's consistent with the Hagerty and Scaramucci timelines, three independent voices converging on roughly the same window without obviously coordinating on it. There's also a political fundraising dimension worth noting briefly because it explains some of the urgency framing. Fair Shake, a crypto focused political action committee, spent $12 million backing Trump endorsed crypto friendly candidate Barry Moore in Alabama's GOP Senate primary runoff, and Moore won. The PAC says it has nearly $150 million in cash on hand, still available to deploy. That's a specific documented financial commitment to building what the PAC itself describes as the largest pro-crypto voting bloc in congressional history. And it's a concrete reason behind the urgency many industry voices are expressing. There's real money actively shaping who holds these seats heading into the midterms on a timeline that runs parallel to the Clarity Act's own legislative clock. So here's the honest synthesis of where all of this actually stands. The Clarity Act has cleared committee with bipartisan support and passed the House previously. It needs all Republican votes plus 7 to 10 Democratic votes to clear the Senate floor. Multiple informed voices, Scaramucci, Hagerty, Armstrong, are independently pointing to a window of late June through July for a floor vote, with presidential signature following in the following months. The urgency argument is real and specific. Losing either chamber in the midterms hands committee control to chairs who have already voted against this framework, which could mean a multi-year delay rather than a short one. Separately and concurrently, Illinois has already signed its own 0.2% transaction level crypto tax into law, taking effect January 2027, regardless of what happens federally, which is a reminder that state level friction doesn't wait for federal clarity and isn't preempted by it. And the broader argument that altcoins benefit disproportionately from Clarity Act passage rests on a real structural distinction: tokenization and smart contract platforms versus Bitcoin's store of value thesis, even if the specific price and flow claims attached to that argument deserve their own independent verification rather than blanket acceptance. Which of these threads do you think matters most heading into the summer? The Senate vote count, the Illinois precedent other states might copy, or the altcoin versus Bitcoin positioning question? Drop your take in the comments. If this gave you a clearer picture of what's actually documented here, go ahead and like it and subscribe for the next one. Share it with someone who's only tracking the federal timeline and has no idea Illinois already moved on its own. The Clarity Act vote count is public. The Illinois tax text is public. Anthony Scaramucci's odds are his opinion, clearly labeled as one. None of it needs to be dressed up. It just needs to be tracked accurately because the bill that passes and the states that tax it anyway are both going to matter. Stay informed, stay positioned. I'll see you in the next one.